evening, everyone. Elliot Hershman, CPA with Alpha Professional Services. We focus on business accounting and taxation. And I'll pass the mic over to my associate, Mel Cherry.
My name's Mel Cherry. I've been in practice now for about 55 years. This new tax law reminds me of 1986 when there was a big change in the tax laws, and I don't know if you realize that was a time when they put prohibited transactions in and losses and real estate losses. And it was just a mess. And now we're coming into the phase 2 of that. And the reason is that as soon as you get lawyers and congressmen involved, it starts to get complicated. Mainly because most of the staff in the congressional offices are young people. And they never really worked in a business or had a responsibility of a business. And they dream up all these various schemes and rules that really are not real. So, you know, it takes time. And then we've seen this before. The laws are changed and then gradually Congress works on them and changes them back again. So, you know, the old story, what comes around goes around. Yeah, sorry. Sorry about that, folks. Okay.
Thanks for coming. My name's Tom Foglia. I've been in practice for 28 years. I've been the last 12 years on my own, a partner at a firm. We provide tax planning, wealth management, and investment advisory services. With respect to the tax law, I could say where there's confusion, there's profit. I mean, I think there's a lot of things in this law that will benefit pretty much everybody in this room to some extent. Even though you kind of hear like this is potentially a tax cut for the rich, I really think this is an across-the-board tax cut for everybody here in some way.
Thanks, Tom. All right, so little disclaimer. Just want to make sure everyone understands that this information is for informational purposes only. My point being that this information should not be construed as legal advice, tax advice, or a recommendation. So see your accountant, see your attorney. This is only for the fun of it, okay? Now we're going to give you an overview of some very complex information. And if I understand correctly, we're going to have a clicker so that we can control the projector.
The clicker is right on the table there, and it should be working. Does anybody hear that feedback? Okay, let me see if I can fix that here.
All right.
Actually, I think it's the room.
All right, so a little information about me. I understand that this information is going to be available to everyone online. Is that correct?
Yes.
Okay.
With your permission. With your permission.
Of course. Background about Mel. Mel's an expert on estate and PA inheritance tax returns. I'm sure he'll be glad to tell you about that. And Tom has extensive experience in managing complex tax portfolios. So it's going to be an interesting group of people you're talking to. All right, so what are we talking about today? The Tax Cuts and Jobs Act, signed into law December 22nd. And of course, all the corporate changes are going to be permanent, but the individual changes all phase out after 2025. Here's a quick overview of the tax rates. And is there any question about this? Can everybody see what we're looking at here? Basically, what you're looking at is a modest decrease in tax rates across the board. I think that, contrary to Tom's statement, I think that people who earn more money will benefit more. But that's just my personal feeling about that. Capital gains tax rates are unchanged. I believe that's correct. I want to point out that married filing jointly The capital gains tax rate is 15% for people who earn from $77,000 to $479,000. So the vast majority of people will be in that zone. But if you're below that $77,000 number, the tax rate is 0 on capital gains. Now, lots of changes on Schedule A, and we're going to spend a little bit of time on this, so bear with me.
Elliot, do you want your questions during or after?
We can handle some questions.
Okay, so if anybody has any questions, please come. There's 2 microphones, one here and one in the front of the room. Please come to the microphone and ask your question, please.
And I'm going to let Tom handle this one.
Let me just go back, Elliot. I'm not sure if did you mention the net investment income tax? Okay. There's also, in addition to the capital gains rates on the prior slide, there's also there's something called the net investment income tax. There's a 3.8% tax on interest, dividends, and other passive income that comes through on a tax return. And that was originally a tax that was implemented as part of Obamacare to help fund that. That did not go away. So the potential highest capital gain rate is basically 23.8% for federal. It could be higher if you have certain types of assets, but essentially that's the capital gain rate. With respect to the changes on Schedule A, that's your itemized deductions where you can write most of your things off. Most people probably utilize that form in this room. The standard deduction has increased, which was that on the first slide there? That's the next slide. We'll touch on that in the next slide, but there's been a standard deduction increase, which may make individuals' lives easier in terms of how they file their tax returns. They may not have to itemize their deductions. That has been increased to $24,000 for a married couple. The state and local income tax deduction, which probably received the most press, is capped at $10,000, and that includes your real estate tax, your state and local tax, your property tax, all combined. That can't exceed $10,000. Moving forward, there's also been a denial of a home equity loan interest. The interest paid on a home equity loan to buy a car, to buy a personal boat, that interest is no longer deductible. The only interest that's deductible, which is sometimes termed a HELOC, would be loans that you borrow from the bank and you use that to build or improve your home. That would be considered part of acquisition indebtedness. That interest would still be deductible. So the complexity is if you have an old home equity loan that's outstanding, took out $100,000, used $50,000 to improve your bathroom and kitchen, $50,000 to buy a car, you basically have to allocate that to deductible, non-deductible interest. Loan for mortgage interest deduction, which impacts people in this room or buying real estate, that deduction is limited to indebtedness of $750,000. It used to be $1 million. If you do have debt that's greater than $750,000, that is grandfathered going into 2018. There's also a limitation on itemized deductions for higher net worth taxpayers where when you add up all your itemized deductions, your interest, your contributions, your miscellaneous deductions, that was further phased out based on how much your income was. There was a further reduction. That is now gone. That's actually a benefit. There's been a small change with respect to contribution deduction. Contributions are still allowable as they always have been. However, they actually increase the amount of contributions you could take on your tax return. In the past, it used to be, I'm not sure if anybody does this, if you earned $100,000, $200,000, you can deduct contributions in the current year up to 50% to qualifying organizations of that income. So you could deduct $50,000 against 100. Now it's 60% of that income. So you can deduct more in the current year. Medical expense deduction threshold has been reduced to 7.5% from 10%. So that might, provide an opportunity. Unfortunately, you really don't want to benefit from that deduction, but if you do, they did lower that limitation. So 7.5% of your AGI. So if your adjusted gross income is $100,000 and your medical expenses are over 7.5% of that, which is $7,500, that amount you could deduct. Miscellaneous itemized deductions are now gone. Can't deduct any miscellaneous itemized deductions. So that would include things like you might pay for your tax return prep. Can't hear back there? Hello? Hello? Is that better? Here we go. Sorry about that. So There we go. So miscellaneous itemized deductions are eliminated under the new tax law. That would include things like your tax preparation fee, investment advisory fees, safe deposit box fees, et cetera. Job search expenses, things that might fall into that category are no longer deductible. Personal and casualty theft losses are deductible to the only, or basically moving forward, the only casualty losses you can deduct are those for which you incur in a federally declared disaster area. So that reduction or that deduction has been eliminated moving forward. Typically, in 2017, the deduction for a casualty loss was, first of all, to even get it, you have to have over 10% loss compared to your adjusted gross income. So if your adjusted gross income was $100,000, your loss had to be greater than $10,000. Yes?
Question. These are just personal deductions. In other words, the mortgage limitations do not count on a Schedule E or an investment property. In other words, there's no limitations on that. Is everybody quite clear?
Yes, the mortgage limitation is only with respect to your principal residence and a secondary residence. If you have mortgage indebtedness on an investment property, there's no limit. Mortgage insurance premiums are also no longer deductible for contracts entered into after 12/31/17. Do you want me to mention about the 2018 real estate taxes? All right. In 2018, you may have, or 2017, you may have read in the paper or heard in the news, prepay your 2018 real estate taxes, property taxes in advance. That's an issue. Depending on your jurisdiction, if the tax is not truly assessed, you can't just pay it. It has to be assessed, and there's been some IRS guidance on that, to be deductible. Otherwise, it's kind of like a deposit on your, and it's not deductible. So then the issue is, even though a jurisdiction may have opened up their website saying, we'll accept 2018 payments, that doesn't necessarily mean it's deductible. But you may have paid it by the end of the year. So then the question is for 2018, if it wasn't deductible in 2017 because it wasn't a bona fide assessment, is it even deductible in 2018 because you're a cash basis taxpayer? Now, I would say it should be, because that would be the right answer. But there's an issue because in a cash basis taxpayer, you paid it in 17. So there's an issue there with respect to real estate taxes. Yeah. Want me to do this? Okay, so the standard deduction has been increased for single, let's go right to married is $24,000. So that means your itemized deductions have to exceed $24,000 for you to get a benefit of those. So that would be your mortgage interest, your real estate taxes, charitable contributions, no more miscellaneous, and medical. But your medical, most people don't get a medical benefit because the threshold's so high. If those things aren't higher than $24,000, you get the standard deduction. So for most people, it'll probably simplify their tax return because they probably don't get close to the $24,000 for married filing joint, in my example, and their tax return will become much simpler. So if you think you're going to be limited by this, or you're on the cusp of being about $25,000, $26,000, if there's any way you can kind of bunch some deductions together, that's something you should think about to exceed the thresholds in any given year. Want to keep going? Okay. All right. Other changes on the 1040. Personal exemptions have been suspended. So you can no longer take an exemption for yourself, your children, etc. The kiddie tax has been modified. So the kiddie tax would be a tax for minor children on their income. Historically, that tax, assuming they exceeded certain thresholds, if the child had investment interest income, dividend income, et cetera, that exceeded certain thresholds, that would be taxed at the parent's rate. The new law basically taxed that, and I don't want to get too detailed here, but it actually is more punitive, and maybe Mel can expand on this, but the tax rate for a child that has investment income, unearned income that exceeds the thresholds will pay tax using the trust tax rates, which I think the maximum rate kicks in at about $12,000. Is that? So you're basically, you got to be careful with income shifting to minors because that could become much more expensive. We'll come back to the AMT in a second. The Obamacare shared penalty has been repealed. planning idea, get divorced by 12/31/18 if you're going to get divorced, because you can't deduct the alimony payments. Likewise, they're not taxable if you receive them. That's a huge change in the divorce area. If you have an existing divorce decree, that you could still deduct those payments. Moving expenses, that's another deduction that's been repealed. Discharge of student loan interest on death or disability has been repealed, or added as an exemption. And this, to me, is one of the biggest ones. So, to me, the biggest beneficiary of the Tax Act is somebody who has income less than $400,000, they're married, have one earner, and they have 5 kids under age 17. You're going to get $2,000 per person as a credit. $1,400 per child is refundable. So that phase out, that child tax credit phase out, used to be phased out at a much lower threshold. It's not phased out until $400,000. It used to be about $150,000. So that's a significant opportunity or tax deduction that's going to be available. The other one that's pretty significant is, I guess this is in lieu of the voucher program, quite frankly, but the 529 plans, which are college savings plans. You could put this, which is one of the best savings tools around. You could put money in today for even your unborn grandchildren, and there's a way to do that. You could put money away now, let it grow for 18, 19, 20 years, totally tax-free, assuming you take it out for qualified education expenses. You can now also take out the money for private elementary school or high school, including religious schools, for the same purpose, tax-free. So that limitation is much lower, though. You can only take out $10,000 a year. So in planning for that, you don't have to fund as much as you would for college. Anything in Spain? That's good. AMT. Does anybody know what the AMT is? It's the minimum tax. We all want to pay the minimum tax, right? No, we don't. It's not really a minimum tax. It's the worst tax. So they didn't repeal it as much as they said they wanted to repeal it. But what has happened now is, in the past, individuals with income from probably 200 to 750,000 were all caught in AMT. What causes AMT tax, which is a bad thing, are high real estate tax deductions, state and local tax deductions. Maybe you have a spouse that has stock options, and there's certain types of stock options that can cause an alternative minimum tax. Somebody has large capital gains, it can sometimes trigger alternative minimum tax. Now with the reduction or elimination or minimization of the state income tax and the elimination of miscellaneous itemized deductions, which are also an add-back for AMT, not as many people will have those AMT add-backs. In addition, there's an exemption for AMT, which basically says if your AMT income is X, we're going to let you write off a certain amount as an exemption. That exemption was phased out at a very low income threshold. Now it's not. For a married couple, that exemption is not written off until you hit income of $1 million. So what's going to happen is most people pretty much are not going to pay alternative minimum tax moving forward who are under that threshold. Good.
All right. Let Mel talk now about estate taxation.
Okay, you'll nudge me again when I go over, Elliot. One thing I wanted to say in regards to what Tom had to say as far as the changes and the doing away with exemptions and a higher standard deduction. In a real world scenario, I've done maybe 10, 12 returns already. Very simple returns, minimum and middle income people. And one of the things that my computer program allows me to do is to extrapolate or use this year's 2017's income and deductions and convert it over to 2018 tax. So in other words, the computer takes off some of the things and adds some of the things to come into alignment with the new law. And what I found in practically a majority of all these returns, the 10 or 12 that I've done so far, which is pretty good in the early stages, they're better off. If they have more children, then they're going to get more back next year than they did this year. But it does the comparison. So I would think, and I'm not talking about business now, I would think on regular, income earners, W-2 wage earners, that the new law, depending on how many children they have and what their deductions are, they'll benefit. Now, there's an offset to that. As you realize and as you've heard, they're going to be changing the withholding tables, okay? So even though you're going to do better than you did last year, if they lower the withholding tables, it's going to come into, depending upon how much they change it, it's going to eat up some of that refund or additional refund that you're going to get over and above what you got this year. Any questions on that discussion? Anybody have a question on that? Okay. Now, my part of this discussion, we're going to talk about estate and trusts. And don't forget, every one of you is going to have an estate, whether you like it or you don't like it. Okay? You're going to have an estate. And my best advice to you is don't ignore it. In other words, from all my experience, it's going to cost your heirs, they're going to get less money from your assets if you don't do something about it. What you have to do is, and this is a plug for any attorney, is to have a will, to have a power of attorney, and to have a medical directive. That is the most basic documents you have to have. Because if you don't have them, A, some attorney is going to make more money, and B, your heirs are going to get less of your money, and C, the government is going to get more, and your heirs are going to get less. So if you can spend whatever legal fees are now to get a will done, to get a power of attorney done, to get a medical directive, it's going to save your family lots and lots of sorrow and heartbreak and fighting, okay? And fighting and court costs. So do everybody a favor, just a plug, get those basic legal documents made, no matter what it costs. Okay, let's get back to estate tax, the changes in the estate tax. Everybody last year in 2017, everybody had an automatic deduction from their assets when they died for federal estate tax. Now let me separate and define it. Pennsylvania, the state of Pennsylvania, has an inheritance tax. That's the Pennsylvania inheritance tax. The federal government has an inheritance tax. The difference is Pennsylvania taxes from $1, okay? When I say $1, I'm talking about your total assets less all your expenses and debts. And from that, there's that net figure, they apply a tax. The tax rate is based on the relationship of who the beneficiaries are. The federal government, unlike the state, taxes after a deduction. You have to come up to a certain amount before they tax. Now, previously to this, it was called the Unified Gift Tax. And what that meant was everybody started off with a credit. You started off with a credit. It used to be, years ago, it was $350. It went up to $670,000. It kept going up until last year. It was up to $5 million. Well, you figure that, well, let's take a, anybody have over that much? No? Elliot, I didn't see you raise your hand. Okay, so in other words, it didn't affect most people, all right? Now, through the generosity of our president and Congress, it doubled. It went from $5 million to $10 million. Well, what does that mean? To most of us, we'll never reach that amount. You don't have to worry about it. But there are quite a few individuals that own assets more than that, okay? So what that meant, that is, even in your lifetime, if you gave away part of your estate while you were living, okay, it was called a gift tax. There was no tax to pay because you had that $10 million or $5 million in 2017 credit, but you had to notify the government. And that's where that discussion comes in about, if you remember, you always heard somebody say, well, you can give the first $10,000 away and there's no tax to anybody. Or you can give, last year it was up to 14, I think. No, this year it's 14. Last year it was 12 or 13.5. I don't remember what the number was. But the point being is that you didn't have to file any returns as long as you kept it under that amount. If it goes over that amount, and it's $1 million, $2 million, whatever it is, you have to file a gift tax return. And you have to tell the government, well, I'm giving away some of my money now before I die. And they keep that on record. And they keep that so that when you die and your heirs, your executor, files a tax return, an estate tax return with the federal government and says, well, he only had $9 million when he died. But they add that money back on that previous return, and when you go over it, then you have to pay. And it's a pretty stiff tax, okay? I mean, it starts at 35 and 45%. So, you know, a good part of your estate can go. Well, through this legislation, it doubled from 5 million to 10 million. Now, it sounds like it doesn't affect a lot of people, but it may, okay? It may. Well, they dropped, I mean, they said, the federal government said, the IRS said, well, we process less of those kind of returns now. Well, sure, not that many people have that money. There's another feature of this is called portability, okay? And what that means is, if let's say we have a husband and wife, and the husband passes away, and his half of the estate was $5 million. Now, well, he didn't pay any tax, okay? But now, the difference between the 5 and the 10 million now, okay, that's his portability amount. And that can go to the wife. So now the wife has 10 in her deduction of 10 million, but she also now has the $5 million from his. So her deduction goes up from 10 million to 15 million. Or last year, it goes up from 5 million to 10 million. It's a very important factor. And why do I say that? How it could affect you? It might affect you, even though you think you don't have that kind of money. If you die in a horrific accident or some kind of catastrophe and there's a lawsuit, your estate could be worth that much, as funny as it sounds. And I know it's not going to affect you, and you're not going to have, be able to spend it, but your heirs can. And you want to do certain things so that Uncle Sam doesn't become an unknowing heir or unwanted heir to your estate. Any questions on that?
Mel, I have a question. So people get hung up on the annual exclusion gift, which is currently for 2018 is $15,000. So as Mel mentioned, if you give more than $15,000 to any individual, you may have to file a gift tax return. Even though you're not close to 10 million, you might have to still report that, as Mel indicated. Are there any other gifts, Mel? Are there any other gifts or ways you can give money without it being applied to the annual exclusion?
Yeah, there's several ways, and some of those we talked about earlier today, the 529 plans. That's something that you want to consider, and I'm sure Tom will explain that if you'd like to have a question on that. But there are different reasons and uses to be able to exclude from that. What's that? Yeah.
That wouldn't count,
right? And education, yes.
So
those, what Tom is alluding to is, if you let's say you pay for your nephew's education, or you pay for your niece's medical treatments, okay? Those don't come under that $14,000 exclusion, okay? Any questions? Sir?
question. How do trusts fit into all of this? A lot of folks here put their properties in trusts. How does that fit into the estate tax situation?
Okay. Trusts, you have to understand, are very, very complicated. There must be about 10 or 15 different kinds of trusts and different ways of formulating trust and reasons for the trust. Okay? If you have to remember, trusts are in perpetuity. Okay? They hang around and hang around and are around, could be around forever unless you put certain provisions in the trust that end them. Okay? But they are around, and they're like taxpayers too. Okay? They earn income. They file tax returns. They pay tax. They have deductions, just like in an individual, but not on the same basis. They have different kind of deductions. So it's a very, very complicated scenario. And my best advice is to, if you feel that there is a need for a trust, or you have the kind of money or purpose, like a disabled child, you want to start what's called a special needs trust or a life insurance trust. There must be 20, 25 different kinds of trusts. I suggest you contact a trust attorney, because they're the ones that have to draw it up.
Land trusts, how does that work?
Well, I just wanted to add to the trust discussion real quick. So there's a lot of different uses of trust, but generally there's revocable trusts and irrevocable trusts. So a irrevocable trust is nothing. It's like I can do whatever I want. I can revoke it. And many people form revocable trusts as will replacements, because anything in there is disposed of based on the terms of the revocable trust, which you could be trustee of. You could change anytime you want. A lot of times people use those for trusts for maybe investment properties or other assets that are in other states where probate is difficult. It makes probate a little easier. Then there's irrevocable trusts. If you move assets to an irrevocable trust, one you cannot change, as Mel mentioned earlier, if that transfer is over $15,000, or in the case of married couple or whatever, over $30,000 for each spouse, you're going to have to file a gift tax return and report that on a gift tax return, saying I gifted something to something that's irrevocable, which presumably is kids or grandkids, et cetera. So those are, in my mind, the two broad distinctions.
Well, let me expand on that a little bit. Yeah, we're going to, okay.
Part of my question.
Well, what we're talking about now is, and as Tom mentioned and Elliot just mentioned, there are grantor trusts, okay? And most of the time, a grantor trust is a irrevocable trust. And let me give you an example. You know, several years ago, everybody, all the older folks went to a seminar and they heard from an attorney how to formulate a trust, and they're going to save all this money, and there's no probate, okay, when you have a trust. And it's true, there is no probate when you probate, meaning you don't have to go through the probate process in a court to transfer the property upon the grantor's death, okay? Technically, what happens is you have to fund either an irrevocable or a revocable trust. Now, what they were doing, most of them were revocable trusts. They were in the husband or wife's name. But what needs to be done, and essential to this type of title to your assets, is you have to fund the trust. In other words, you have to put the assets into the name of the trust. Now, in a irrevocable trust, as funny as that sounds, it can still stay in your name with your Social Security number. But what happens is when you pass, it then becomes an irrevocable trust. Okay? It can't be revoked. It's now under the provisions of your original trust. Okay? And then it files tax returns on its own. Any questions on that? Sir?
Yeah, part of my question before was does the new Trump tax plan treat trusts differently than before? So it's the
No.
same treatment as before?
Right, right.
No change?
It didn't even change the rates. It changed the rate very slightly. I looked at them today with very slight changes. There are some changes in the state trust income tax rates, but very, very small.
Okay, thank you. That was an important question.
Any other questions? Okay, so let's see. There's the estate and trust tax brackets on the screen. Okay, what do we got? 2, 4, 5, 4. Okay, and they've changed a little bit. But you have to remember, now look at it. 30%, the highest bracket is 37% tax on an excess of $12,500. Okay, from $12,500 to the total, it's at 37%. Well, that's a high bracket. That's a high bracket. And individuals sometimes may not be that high. It's not at 12.5. It can go up. If you look at the other ones, it's at a higher 77 point some thousand. So it's a very high rate. Okay? So there it is there. Okay? So, 35%, you're over 400. Okay? Or 77, 25 at 77. And here we're at 12.5. You're at 35 or 37. It's a very high rate. Okay, and there are some ways to get around it. Not let's get, I don't want to use the word get around it. I don't know what the words were. To accommodate it, to change it, to save taxes. Okay, I'm only going to give you one, and I don't want to hold this up. I want to give you one example. Okay, and that is when an individual has United States government bonds as their investment and they die, okay? If they don't have on there a POD, payable bond death, a specific beneficiary, it goes to their estate, okay? Not just the income, the total amount of the bonds goes to their estate, okay? However, that's the one asset where the executor has the power and the choice. He can put that income, the interest, the accumulated interest, either on the individual return or the estate return. Now, obviously, which would be better? The individual has lower rates, okay? So that's a tool that we use to save money for beneficiaries of an estate. Okay. Any questions or anything else on that? Any questions in general on estates? No, everybody, What's that? Go ahead.
Yeah, there's a question.
What's your question?
Please come to the microphone right here.
I'm sorry, I can't hear you.
I turned it on. Go ahead.
For clarification purposes, when you're looking at the top rate of 37%, if we have a piece of real estate that's in a living trust, a revocable trust, if the property produces more than $12,500 in income, above that's going to be taxed at 37%.
Huh?
It will not be a pass-through. Revocable. No, revocable. It passes through through your regular tax rate. So this is only applied
Right.
to irrevocable trust.
That's right.
All right. So as real estate investors, we would typically have our properties in a revocable trust, and therefore the pass-through rates would go. It would be a pass-through entity, and the taxes on the income from that property would be as ordinary as our ordinary income tax rate.
That's correct. Yes.
Thank you for that clarification.
Okay. Yes, ma'am.
somebody dies in 2017.
I'm sorry, could you
Go
turn the
ahead.
mic
Somebody
around?
dies in 2017, I got you.
Okay, if somebody dies in 2017, but by the time you finish going through everything and settling it, do you pay the tax rate of 2018 or when they've passed away?
No. When someone dies in a year, okay, from the date of death back to the beginning of the year, they have to file a personal income tax return, just like they would if they were alive and nothing happened.
Could you put the mic
From the
closer?
date of death,
Hold the mic closer to your mouth.
I'm
please.
sorry, from the date of death, generally, I'm saying generally, there are provisions where you don't have to stop at December 31st, but let's make it simple. From the date of death to December 31st, any income that their estate produced, you have to file a federal and state income tax and pay income tax. Either pay it on the estate rate or distribute it, and that's what we're going to talk about in a minute. There is a rule that says you have up to 60 days after the end of the fiscal year to distribute that income to the beneficiaries, and it's a pass-through. You don't pay the estate rate. The individuals have to pick it up on their personal return. Okay, does that answer your question? Yes. Okay. Anything else?
Any other questions?
What did you say, sir?
Come to the microphone, please.
Well, that's what they're saying, okay? That's what it says here, that certain ones will be. Now, I can't see the executor's fee. That'll still be deductible, okay? In other words, normal expenses of the estate or the trust will still be deductible. Some other ones that you have, like mortgage interest and stuff like that, will revert back to the personal income tax. But an executor's fee, an administrator's fee, of course the accountant's fee, the attorney's fee, those will all still be deductible. Okay? Any questions? That's what I just did. I just said the 65. Yeah, after the end of the year, okay, they have 65 days to make distribution so that it passes through to the individuals, to the beneficiaries, rather than at the estate rate. But you have to understand, you actually have to give them the money. It's not just to say, well, we're going to pass it through. You actually have to give them the money to get the deduction. Okay? Any questions? Right? Okay, Elliot?
Thanks, Mel. So the 65-day rule, just to clarify, when you're preparing your tax return for the prior year, if you've made an error in judgment or an error in accounting, and you find that the distribution that you made out of a trust or estate is insufficient to lower your tax rate, and you actually should have taken more out, you have 65 days from the end of the year to make another distribution as an adjustment. So I just wanted to clarify that. All right, let's talk about selected changes in business taxation. There's obviously a new flow-through deduction. I'm sure everyone's going to want to talk about that. The domestic production deduction is repealed. That's something that a lot of architects and engineers were taking advantage of, and it gave them an above-the-line break on their taxable income. That is gone. There's changes in depreciation. The 21% corporate tax rate is in effect now instead of the rate that was previously, I believe, 35% or higher. The rate for personal service corporations is no longer valid. Like-kind exchanges on things like cars has been eliminated, and now that's only limited to real estate. Entertainment deductions are no longer allowed. This could be huge, folks. I'm surprised to see that attorneys were willing to make this sacrifice. Personally, I know some attorneys who are spending tens of thousands of dollars on entertainment expenses, and they've been able to deduct half of it, and now that is no longer the case. Now, certain types of meal deductions are still valid.
Okay, so, Elliot?
Yes, sir.
So officially, they can't deduct those entertainment expenses, but what can they call it so that they can deduct it?
Well, let's see, we could call it business development. No, I'm only joking. I would never suggest such a thing.
Okay.
There's some creative ways to get around it, but none of it matters unless you get audited. And then, of course, then you've got to pay the piper.
Well, what are some of the non-auditable ideas
All right, well,
that we won't hold you?
I can tell you what is deductible. Meals that you buy for your employees continues to be deductible.
Is that W-2 or 1099?
It can be actually, I believe, anyone, as long as they're working for you. Business meals are defined as entertainment in the IRS code, so there's still a lot of debate about how they're going to be handling this. We've been talking, among other accountants, about the distinction between a business meal when you're traveling to work for a client and then a business meal where you're down at a fancy hotel meeting another person for marketing purposes. It's really not clear, and we're going to look to the IRS for additional guidance. We've actually asked them that question. We're waiting for an answer.
So what would you say would be absolutely positively no effing way that you could deduct an entertainment expense? And then the other things that you won't mention, we could figure out a way. If you don't talk business, you can't deduct it.
If there's no business purpose, you certainly are
monkey business, does that count?
Entertainment in general is not deductible. So that means if you're going to be buying somebody Eagles tickets, am I on the wrong screen? There you go. There you go. I knew there was an Eagles reference here somewhere. If you're going to be buying tickets for someone as entertainment, that's certainly not deductible. Anything that you would call entertainment as opposed to meals is absolutely not deductible. The business meals issue is still to be resolved.
So if you're sitting at an Eagles or a Sixers or any other sports event next to somebody and you talk about, apartment complexes or who knows what, does that count? That's talking business.
If you're in an entertainment event, it's not deductible.
Even if you're talking business?
Correct.
How about if you talk business in the parking lot? Sorry, just trying to, it just seems crazy.
The only thing that is deductible would be certain types of meals, and even that's, the extent of that is still questionable. So it's really a huge problem. Anybody have a question? I'm sorry, I can't hear you.
Is this meal deductible?
Is this meal deductible?
Yeah, it's business. Believe me, they're not here to see you, Elliot.
Education.
I was joking.
Under professional education, if you're coming here and you're paying for your meal or paying for this program, it is professional development.
There you go.
Okay, Larry.
All right.
So, Larry, you're going to pay for all of our meals, right? And you'll call it professional development. There you go. Yeah. I don't want to. Don't let me cry for that.
All right. So employee gifts and awards are not deductible. The maximum corporate tax rate on net capital gains is repealed. I'm going to move on from there. Business interest expense is limited to 30% of its taxable income with certain adjustments. I'm going to move on to the next slide. We already talked about entertainment. Non-operating losses, the NOL deduction is limited to 80% of taxable income. And then another big subject, depreciation. I think we went to buy some stock in car companies. I probably shouldn't say that. I'll take that back. But here's the problem. Depreciation on passenger automobiles has increased. So in the first year, in the past, Mel, you remember what the first year deduction on passenger automobiles? It's probably under $3,000. Does that sound right? Now it's $10,000. So could be an opportunity there. Of course, that's a Mercedes G-Wagon. That's probably more than most of us can afford. I think that's a $150,000 vehicle. So the new law provides for a 15-year recovery period for qualified improvement property, and that is defined as an improvement to an interior portion of non-residential real property. That doesn't include enlarging the property, elevators, or structural framework. And we'll get into that a little bit more. Now, Section 179 expense. Just as a curious question, Does anybody know what Section 179 expense is? All right, well, we got a couple. All right, so a Section 179 expense is an expense that you can take in the current year on an asset that normally would be long-lived. So for example, simple example, you buy a computer for $2,000. To simplify this to the simplest possible example, you could depreciate that computer over a period of 5 years. So instead of having a $2,000 expense in the current year, you're going to have to take $400 expense this year, $400 in the next year, and so forth. It's not that simple, but it's close enough. So Section 179 says, that's an IRS code section, says that you can expense the entire cost of that computer in the year that you purchase it. So why am I talking about this? Because the numbers have changed and the definition has changed. Qualified property of up to $1 million can be expensed in the year of acquisition. Section 179 property now includes certain depreciable tangible property used to furnish lodging, and qualified real property now includes improvements to non-residential real property. These things can make a huge difference to your tax accountant. Make sure you talk to them about it if you're investing. Bonus depreciation is another area where the regulations have been relaxed. Certain business assets may be expensed in the year of acquisition. So this is in addition to Section 179. Qualified property now includes used property. It used to be that bonus depreciation only applied to a new purchase. Passenger automobiles will continue to be eligible for bonus depreciation up to $8,000. And if an asset was acquired after September 27th, 2017, the taxpayer can elect to apply the 50% bonus depreciation rate on 2017 tax return. In other words, there are some regulations that were passed for the 2018 tax law that apply to 2017 as well, and this is one of those items. Property obtained from a related party or between members of a controlled group is not qualified. So, simple example. Taxpayer runs his business from a building that he owns. He improves the suite in his building. Because of these new tax regulations, he can take advantage of bonus depreciation, Section 179 expense, and a 15-year recovery period. That'll make a huge difference in your expense. All right, now, I imagine a number of people have heard about the flow-through deduction. How many people are looking for information about that? Okay, so here's what's going on. There's basically two different groups of people who this will affect. One of the groups is people who make under $315,000, and the other is the group who make more than that. The people who earn under $315,000 have actually very simple rules to live by. So, a little background. And I apologize for reading the slide, but an individual's business income is taxed at individual tax rates less 20% of qualified business income. And in general, qualified business income is equal to your net business income. There could be adjustments for salary or payments made to the owner for services. But in general, if you're talking about a sole proprietor, you're just talking about a 20% deduction. It applies to sole proprietors and other flow-through businesses. So there are some limitations, but again, most of those limitations don't apply to people who earn under $315,000. And it's interesting to see what political groups were able to influence this law. A specified service trade or business is any trade or business involved in the performance of services other than engineering or architecture. And in general, those services include any trade or business where the principal asset is the reputation or skill of one or more of its employees. So these businesses are excluded from the flow-through deduction. So the exclusion doesn't apply if the taxable income is less than $157,000 for individual taxpayers or $315,000 for married filing jointly. Above those income levels, there's a threshold where it's phased out, and there are other more complex calculations involved. So now let's just talk about the flow-through deduction for real estate rentals. If real estate rentals are your trade or business, do I need to clarify what a trade or business would be? If you're a real estate agent, if you're a contractor, if you're a real estate investor, your trade or business is real estate rentals. But if you're a real estate investor that is not a real estate professional, then the flow-through deductions may not apply. And again, these are one of those areas that we've got questions out to the Internal Revenue Service. So we're going to wait for additional guidance from the IRS. The best minds in my organization are working on this, and we're working with the IRS to resolve these issues. All right, so the only thing left to talk about in our presentation is just a quick overview, but hold on one second. Go ahead. Oh, absolutely. I'll pass the mic over to Tom.
I just want to expand on a couple, or highlight a couple of things that Elliot spoke about. One was, and I probably mentioned this, but bonus depreciation can now be taken on used property. That's a significant change. So if you bought in this case, you bought a rental property and it's furnished, that would have been used property, and you'd have to depreciate that over 5 or 7 years. But now you can take bonus depreciation, which is basically 100%, and write the furniture and fixtures off. So that's a significant change in the real estate area. The other thing, and I don't want to get too complex, but you can't do a 1031 exchange on an automobile anymore. So many times people get their automobiles, say, hey, let me trade it and get another automobile, lower it, get the sales tax, lower the sales tax. Well, generally you trade your car in when it's maybe fully depreciated. So now that you're trading it in for cash, because that's basically what you're doing now is a tax-free exchange, you basically might have a gain or loss because that reduction in fair market value of the car you're trading it in for, that benefit, looking to buy a car for $30,000, they're going to give you $10,000 for your car. You now have $10,000 you have as quote-unquote proceeds to net against any basis you have left in that older auto. You can't roll that old auto into the new auto. So that's something you need to look out for, I think. Is that okay? Those are just two of the things I wanted to highlight. And, one other one, sorry to do this because you had the article reminded me, because it's going to apply to this room. You can't no longer have personal NOLs, your personal tax return come out to a loss, you have business loss. In the past, you can carry it back and get refunds. You can't carry it back anymore. You can only go forward. That's a huge change. So that's something to think about.
One other thing I want to remind you about, even though you may not be doing your own returns, but I think your accountant is going to explain to you, and most real estate investors don't typically understand it, but it's in the tax law. And what that is, let's say you buy a building. I'll just throw a number out. You buy a building for $1 million, okay? And your accountant's telling you, you can't depreciate the full $1 million. You say, why? I paid $1 million for the building. There's one thing you have to remember. The building and the land are two different things, okay? So you have to value the building and you have to value the land. Now, the land is not depreciable. As you well know, land doesn't depreciate. Well, you may think it does because the value and where it's at, but it really doesn't. So when you're setting up, or when your accountant is setting up your depreciation, he has to remove a certain part for that, for the land, okay? Normally, it's usually the guidelines are about 10% is for land, but it could be different. You know, I've seen situations where the land is more than the building is worth, depending upon where the building is that you're buying. You all know that, okay? The building, you're not really looking at the building, you're looking at where it's land. Why? You're going to buy it, tear it down, and build something else because the land is more valuable. It's in a highly desirable in business and et cetera, a lot of people. So you have to take care of that. And the other thing too, one other point in depreciation is they used to have a concept, and I'm not quite certain if it's still around, but they used to have a concept, because I had a client bought a building, we did that, because there were different depreciation rates for different components of the building. Now it's called segregation. Used to be called components, okay? And what that is, you buy a building for $10 million, but you get an engineer to evaluate the different parts of the building. The elevator, okay? If it has an elevator, that depreciates faster because it's a moving part, okay, than the walls or the roof or et cetera. So that is one thing that your accountant may be looking at.
Good job. Yes, if you're looking at a significant investment in real estate, certainly consider cost segregation strategies. You can make a huge difference in your deductible expense. All right, so just a quick refresher. Qualifications to be a real estate professional. More than half of the personal services you perform are performed in real property or trade or business in which you materially participated. And you perform more than 750 hours of services during the tax year in that business. And of course, if you're not in that category, you still get a special $25,000 allowance. I believe that's married filing jointly, where you're allowed to deduct up to $25,000 of rental passive income losses as long as you're actively participating. So, wrap things up, let's talk about some planning strategies. These are rather simplistic, but they will get you 80% of the way where you need to go. The standard deduction has nearly doubled, so you're not going to have to itemize. So what does that mean? You've got real estate taxes, you've got mortgage interest, what are you going to do with it? Consider a home office deduction. That's one possibility. Consider incorporating. That's another possibility. Now, entertainment expenses. We already went over that a bit with Don, and I think you got the right idea, Don. We'll look at ways to recategorize some of those expenses. Or if you're an employee and you've got employee business expenses, it might be time to start talking to your employer about implementing an accountable plan where you can get reimbursed for your expenses, because those expenses would be a legitimate deduction for your employer. Miscellaneous itemized deductions, we talked about that. Meals. So the issue with meals is very complex at this point. We don't have good answers. Keep excellent records about the meals that you're expensing. As Tom mentioned, if you're going to get divorced, do it before December 31st, 2018. And partnerships. How many people here are involved in partnerships? I'm just curious to say, okay, so it's a fair number. If you're getting guaranteed payments, and you might know what that means, it's basically a payment as though you're a contractor, except it's on a K-1. If you're getting guaranteed payments, you might want to consider taking them as distributions, because if you're taking them as distributions, you'll get a better flow-through deduction, that 20% deduction that we talked about earlier. And let's see, here's our contact information if anybody has any interest in reaching any one of us. And I'm going to pass the mic back to Tom.
A couple more comments. Just when you dispose of rental real estate and you have the recapture of depreciation, which is part of your gain, that capital gain rate has not changed. It's still 25%. So if you bought a property for 100, and let's say you depreciated 50,000, you sell it for 200, the gain of basically 150, 50 of that's going to be recaptured depreciation subject to 25% and potentially subject to the additional 3.8% tax on investment income, assuming you're not a real estate professional. With respect to the meals, again, I just want to go back to that. Meals are entertainment and are not deductible until further clarification from the IRS. And that's all.
One other point, along with what Tom said, a practical point, okay? If you're representing some clients and they're selling a property, okay, or you're selling the property, the first thing I suggest you advise them and yourself is to talk to the accountant who did their tax return. And the reason for that is everybody has a figure that they're going to sell that property for, but they have no idea what the taxes are going to be on it. So in many times, if there's a mortgage on the property and they don't sell it for enough, okay, to include the taxes on it, they can be selling it for less than what they're going to come out with. They may have a negative end result on it because of the mortgage. So again, I would suggest that you, if you're representing somebody, talk to them and find out, do you know what you're coming out with after taxes? Because as I'm sure you're aware, okay, when a property is sold, portion of that gain is capital gain and portion of it is ordinary gain, okay? The amount that you depreciated or the person depreciated over the years, okay, comes back as ordinary gain, and the increase between the cost and the sales price after adjusting for the depreciation comes back as capital gain. So you really need to know and get those numbers down as far as what you're going to come out with after you sell that property. That's been my experience on most of my clients, okay? I always talk, when they tell me, unless I'm told afterwards, okay, and then it's too late, but before they get that agreement of sale, they really need to know what it's costing them in taxes. Any questions on that? Okay.
One more thing on a 1031 exchange, because it's a real estate group. I personally did this, but 1031 exchanges only apply to real estate. So if you ever sell or doing a 1031 exchange with real estate that's furnished, you may have to do some extra planning, because if it's furnished with, you know, furniture, fixtures, beds, all the stuff in there, that's not real property. So somehow you have to extract that from the deal or segregate that from the deal, because that's not going to be eligible for a 1031 exchange should you go that route.
You know who would know that? Most of the time, you have to go and have what's called a facilitator to do a 1031, okay? It's someone that you hire to do all the paperwork and get it all together.
Who would know that a meal is marketing expense or not? I mean, basically, the rules are the rules. So you could say, no, they'll never know. But I'm just telling you what the rule is. I mean, they might never know. But sometimes there's like a separate deal for the furniture. Like I bought a shore house. It's not for investment purposes, but it had real estate, had furniture and fixtures. It had a separate carve out for that. You're right, they won't know. But in certain jurisdictions, where it could possibly come out, I'm just thinking about this. You know, I have some clients have places in South Carolina, and there's a personal property tax on the stuff inside of it, and a lot of that stuff carries over to the next personal property tax return. So they say, well, you sold the property, or we're listing the same stuff. I mean, so that's the way it could possibly come out.
I have a question over here. Airbnb. Some folks are using Airbnb as a way of renting their properties or their RVs or what have you. Are there any issues around Airbnb, either on the expense side or the income side?
Well, obviously, on an Airbnb, you're only going to be able to depreciate that property for the amount of time you actually, A, rent it, okay, or B, have it up for rent, okay? Now, it's a very difficult, renting it is the easy part. For the time that you rented it, that's easy, because your income is related to how much you rented it for, okay? And if you have it up for rental, but it's a problem because it's a part of your house and you use it anyhow. So I kind of feel that you're not going to succeed with the IRS with saying, well, I have 1/3 of the room of my rooms or what house are always constantly up for Airbnb, and I should be able to depreciate that. It's not. It's part of your home. You use it even if it's up for rental. Easy is just to say, hey, look, I rented that part of the house for half the year. I have income for it for half the year, so you're going to take half the depreciation.
Does anybody have experience with that in the room? Anybody use Airbnb? Well, for anything.
They're usually houses.
Well, I mean, because I have some
clients that use Airbnb and VRBO for their ashore properties. So I think this similar rules to the vacation rules, similar to the vacation home rules. If you use your home more than 10% of the rental period or 14 days, it's a vacation home. And if it becomes a vacation home, there's limitations on how much you can deduct on your tax return versus if you don't violate those rules. So once you go over those thresholds, and the same I would think would apply to some extent for your house, unless you have a segregated unit or dwelling on your property, that would be pretty easy to carve out. But the vacation home rules, I think, would be impacted by what you're talking about, or would impact what you're talking about.
Suppose you bought a $100,000 RV, recreational vehicle, and you use it for yourself and your family, let's say for 1 month a year for yourself, but you have it listed on Airbnb for 11 months a year, regardless of how often it actually gets rented out. Can you deduct 11/12 of the...
So that would be 1/12 is, so 10% is more than 10% of the year, right?
That you're using it.
That you're using it.
And 11/12.
I think that your deductions, this is my reaction, not that, and I'll read the first part of this where it says, this information provided is informational. And but anyway, I would say that I think it's subject to the vacation rules. You'd only be able to deduct the deductions up to the income to wipe it out to zero. I don't think you can create a loss.
I have a related question to that. What if you've got a property where your intention is only to do short-term rentals on it? What's it classed as then, and how often can you use it? Is it the same as a vacation home?
Vacation rules are still the same, but when you have short-term rentals less than 2 weeks in duration.
The short-term rentals would be sort of at least 3 months at a time?
Well, that wouldn't be short-term. So you still have the vacation rental rules, but there's also separate rules on whether or not you can avoid the $25,000 limitation that Elliot talked about earlier. There was a $25,000 limitation if you're not a real estate professional. If you have a shore property and you don't rent it out, I believe it's 14 days, it might be 7, for more than 7-day increments, so weekly increments, and you control the property, you manage it, you clean it, you do whatever, you don't have to, it's a little more complicated than that. You'd basically be deemed to be materially participating in the property. And because it's short-term rentals, not 3 months, I think it's 7 days, or it might be 2 weeks, don't hold me to that. You can deduct the rental regardless of your income and a $25,000 exception.
So I'm unclear about what you're saying about where does 3 months fit in here, like you're talking about...
3 months to me, that's not short-term.
It's not short-term?
No, I don't think that wouldn't make a difference. So I think the question is, did you use the property more than 10% of the rental period or 14 days? That would put you in the vacation home rules.
Did you want to follow up? Okay. Are there any other questions? Okay, come to the microphone. And just to remind everybody, we have about 15 or so questions or maybe more on SliDo, so we want to get to those as well tonight. Hold on, let me get your mic. Go ahead.
Hi. I just have a couple of questions on different things that were mentioned. I read somewhere that the home equity loan is still deductible, the interest on it, but not the HELOC, but I thought you said different. I thought you said neither were. Could you clarify that?
Home equity loan indebtedness, the interest expense or interest paid on that loan, whether you call it a HELOC or not, it's a home equity loan, right? HELOC is similar. If you utilize those funds to build or improve your home, they're still deductible. If you use those funds to go buy the RV that was discussed and you're just driving around the country, that's not deductible. If you borrow funds against your house and go buy an investment property, you can basically use something called the interest tracing rules, where you could trace that debt to that particular investment and let it follow it, so to speak. So if you bought a rental property with home equity indebtedness from your primary residence, you could deduct the interest on the Schedule E as a rental property. I'm not sure if that's your question, but the HELOC, to me, the HELOC and the home equity is the same thing.
Right. Okay. I'll ask up afterwards. Okay. A little different. Okay. So the cap still for transfer of funds or gifts, the cap, this for 2018 is still at 14,000, correct?
Yeah.
Yes, okay. It's 15,000 now?
Yeah.
Okay. And what about vehicle leasing? You mentioned about buying. What about taxes and leasing?
Well, when you're saying you're using a lease in your
you're-
business?
Correct. You're
It's
leasing
for
it
business purposes.
for business purposes.
Yeah, it's for business purposes. Well, there still is maximization of how much you can write off, or luxury, they're called listed property. If it weighs over a certain amount and costs over a certain amount, there's certain limitations that you have on the depreciation. And so many, certain amount, no matter what the total cost is, there are minimum amounts, rather than write it over 5 years and have equalization of the amounts over the 5 years, you're limited to certain maximums. And sometimes, depending upon the price of the vehicle, it takes you more than 5 years to write off the total amount of that vehicle.
Okay, but that's if
that?
you're purchasing. But if
Leasing,
you're,
yeah.
okay, so there really hasn't, so what you're saying is there really hasn't been any changes to the leasing?
Right. Yeah.
Okay, thank you. What about gifts? I understand entertainment is, you can't write that off, but what about gifts? End of year gifts to subcontractors?
Gifts?
Gifts,
What are you giving them a gift for?
a bonus,
Huh? Well,
A bo-
bonus
a
is a
bonus.
bonus. It's a bonus.
a bottle of wine,
There's a difference
whatever.
between a gift and a bonus. There's still a limit of, what would you say, $25. But if you're going to give them something, you want to be able to write it off. You're not getting, unless, if it's over $25. Under $25, forget it. But if you're, let's say you're giving them a bonus at the end of the year, it's taxable. It's a bonus. You're going to write it off, and he has to pick it up as part of his income.
Okay,
I think, is your question, what's the distinction between a gift and a bonus? Is that part of your
no,
question?
okay, what happens if you give somebody a bottle of wine?
Well, a case of wine, maybe.
All right, case of wine.
Okay.
All right, still goes under the $25 rule. You know,
$25.
It's a Chateau Dublin something, okay, and it's worth $1,000, okay. Well, it's a gift, but it's still taxable.
To the recipient.
One clarification, if you're giving a gift, like, for example, a huge tray of chocolates to a client or someone else, and it's cost you $200, and there just happens to be 8 people in the company they're giving to, I think you're covered. In other words, it would be $25 for each person who benefits from that. As long as I believe they're partners in a partnership or something along those lines. So you can spread it out a little bit.
Okay.
I'm in a talkative mood today. So on the leasing question, I'm going to come back to that, Mel, because on the leasing question, generally in my experience, it's been better to lease a car than to buy a car for tax purposes. When the car is valued over a certain threshold, though, there's something called the leased auto inclusion amount, where you have to basically add back some of the lease payment. Because of the new tax law, you can now write off $10,000 in year 1, $16,000 in year 2, $9,600 in year 3 if you bought a car. So it makes that decision a little different now. Whereas, those amounts are greater than the lease payment. I mean, $10,000 a year, what's that, $900, $800 a month? I mean, that's a pretty nice lease payment. So you could write that off now under the new law. In the past, first year depreciation was limited to $3,100, second year was $5,100. Well, lease payments are generally higher than that, so leasing was better. And you have the mileage cap issues, but buying is something that probably somebody should look at versus leasing now. But it also depends on, like, some people are just like, I want a new car every 3 years, I don't care. But I think financially it's always better to buy. That's my personal opinion. A 2-year-old car.
Okay. And last
Another question?
Yeah, the health savings accounts. You mentioned about the 529 plans, but I've been doing a lot of reading that the HSAs are just as good in order to invest tax-free, and then you can take out when needed tax-free
On an HSA.
on an HSA.
As long as you spend it it's tax-free as long as you spend it for the purpose that the HSA is there for. You have to have bills If you don't have, if you
Right, or you
make a
can just let it
withdrawal
sit,
and
you
you
can
don't
just
have
let
the
it-
expenses for it, you got to pay taxes on it. But if you have the expenses, you don't have to pay for it.
Okay.
Yeah, an HSA, the difference is, an HSA you can leave forever. You never have to spend, you basically can, here's the rule, HSA doesn't say, like a 529 plan, the rule on that is it's tricky because you have to, in order to get tax-free treatment, you have to take it out in the same year you have the tuition expense. Now, you could save a ton more in a 529 plan, a ton more. You could save up to, it depends on the state, $250,000 a kid if you wanted to. But if an HSA, you could put, I don't know what it is, $6,700 or $6,800 this year. You could leave it in there forever, let it grow, tax deferred. You got to keep all your receipts. And literally 20 years from now, you can withdraw it. And if you have the documentation for the last 20 years that says, here's all my reimbursement, none of that's taxable. So you can let it grow tax-free forever. At 529 is hard because the kids are, like, what are you going to do when the kids are done college? Like, somehow you got to save it for the grandkids or take it out and it'll be subject to tax.
Thank you.
Thank you.
I thought on the 529, you didn't, if for some reason the child doesn't go to school, what do you do with the money? Can you take it out, give it to the next child?
Yeah, you can change the child. They do have that in the provisions.
Suppose no child goes to school.
Could be for another one, sure. Yeah.
No, I mean, suppose no child goes to school for whatever reason.
No child goes to school?
In your 529 plan.
I think when you take it out, you pay taxes on it. It's not being used for what it's for. Now they have changed it for this in the new tax law. It can be for not just college. It can be for a secular education. Okay, the kid goes to Catholic school or high school or a private school. You can use the money for that. Not
Can you
just
take it out
higher education? Yeah.
along the wait? Let me finish. Can you take it out along the way and then put it back in, and then not pay taxes on it while you're using it for some reason, some legitimate reason,
I don't
and then
know.
put it back in?
I can't answer that one.
Like a self-directed,
that's beyond me.
529.
I can't answer that. I don't know.
You can or won't. Sorry. Okay.
Not being recorded, let's put it that way.
Okay. Sorry.
Any other questions?
Okay. Do you have a question? Okay, and then we'll get on to the SliDo questions.
So I'm familiar with a Roth IRA that can be used for children's education.
Wait a minute, say that again. A Roth IRA?
Self-directed Roth IRA used for a child's education.
Child education in a Roth. Well, it doesn't matter what you use it for.
Well, there's
A Roth,
specific-
when you put the money in, when you take it out, assuming it's been more than 5 years, you don't pay taxes on it.
Okay, so how would that compare with the 529 plan for the education you're talking
Well, it's
about?
very simple. You're putting the money in, you're not getting a deduction for it. It stays in there tax-free. It accumulates. So when you take it out, you can use it for anything. It could be for a child's education.
So that
It
might
could
be-
to
that
buy
might
a
be
new house.
more
You can buy
flexibility?
for anything. It's not taxable.
So that's more flexibility than the 529?
More flexibility. Well, it
No,
depends upon what your
no, in
purpose
other
is
words-
for.
Okay, so I know that I use the Roth IRA for my children's college. Okay, for my children, usually it was...
Well, it's not titled for your children's
Oh,
college.
it had their
You
name
just
on it. It
opened-
had their name on it.
But don't forget, they have to have income for you to put money into that IRA. You just can't put money into it for just that. They have to have the income.
We can have an original contribution, a minimal contribution.
But any contribution has to be covered by income.
So you pay your children to send out your mail.
Exactly. Then that money can grow, okay? That money can grow, right?
I'm sorry, what was
Look,
that?
I'm just comparing the validity of the Roth. I know that I used a Roth IRA with my kid's name on it. It was entitled for their education. It was an educational Roth IRA.
I never heard of such a thing.
No
in my
question.
life.
Educational Roth IRA.
I
So-
never heard of such a
okay.
thing in my life. It's not a Roth IRA.
Okay. I'm telling you it was. And we'll talk later. Okay, you know what? I'll contact you later. We'll talk about it another time, okay?
I never heard of it. Any other questions? Okay, you want to start?
Yeah, let's try the SliDo stuff.
Go ahead.
Okay, stand by. Let me get it up on the screen.
One of the questions was, will charitable donations be deductible through your business under the new tax law? I probably will not itemize personally, So I'm wondering if donating through my LLC will preserve the deduction. Now, the answer to that is that for flow-through businesses, charitable contributions will flow through to your individual income tax returns. So in effect, it's as though the flow-through business didn't exist at all. The rules and limitations are different for C Corps, but there are other factors that would offset the benefit. So in effect, if you have a charitable contribution in your LLC, it's going to end up on your Form 1040. Another question, can you take property owned in a person's name and convert it to a company-owned property so it is not subject to the $10,000 tax limit for fee for property taxes? Now, for an investment property, you folks are probably familiar with Schedule E that's attached to your Form 1040. That's for rental properties. There's no limitation on expenses on your Schedule E. The limitation that we've talked about previously this evening was interest and real estate taxes on your personal property, on your personal residence, and those expenses would normally show up on Schedule A. So if you're talking about business expenses, there is no such limitation as you would see on your Schedule A. What business entity offers the best tax advantages for holding real estate? S Corp, LLC, sole proprietorship? Guess what the answer is, folks? It depends. In general, sole proprietor or partnership may be a better choice for small investors. S Corps only allow one class of stock, and that can be a limitation in cases where there's more than one owner. And there also could be basis limitations. So, Don, if you want to switch over to the other questions, we'll field them as well.
Okay, so there was a question that came in this afternoon, or recently. Will your meetup this month discuss opportunity zones in the Trump tax plan? Opportunity zones.
Opportunity zones are really a creature of the state. I don't believe they're federal designated areas. Opportunity zones or keystone zones or whatever give breaks to certain industries in a physical area designated as either a keystone or zone or a opportunity zone. They're state mandated and state controlled programs. They have nothing to do with as far as I know, to do with the federal tax plan.
Okay, I don't know who asked, if that person's in the room, but does that answer your question? Okay. Did we cover charitable deductions already? Okay. HELOC is my primary. I used a HELOC as on my primary home to fund my most recent property. It says part 1 because it didn't allow enough text. Is there any way to still deduct that interest since I can show that the check went to the title company to close on that property?
Did you answer that? Yeah, I think we answered that. That you could use the interest tracing rule. So trace the purpose of what did you use that debt for, and then trace it to the rental property and keep that documentation forever, and you should be able to deduct the interest on Schedule E for the rental property.
Okay. Can you take property owned in a person's name and convert it to a company-owned property so it is not subject to the $10,000 tax limit for fee and property taxes? That's question 1. But question 2, if so, how? Example: convert a real estate investment trust, then make the company a beneficiary of trust. It pays taxes and can deduct with, I think that means no limit.
So we already mentioned that.
Use the mic, please.
Already been answered.
That's asked and answered. Okay, fine.
Asked, as the attorney says, asked
and answered, right. And then question 3, or create a nonprofit entity and have it own the property and you rent it from...
Nonprofit answer, yeah, that'll be a good one.
Okay. Okay, how will it...
That's a bit of a stretch.
Well, okay. Okay, fine. I was going to say something, but how will the tax changes impact management fees that you pay yourself for managing your own rentals? I've been told payments as a percentage of rent will no longer be allowed.
Well, we saw that question before. We needed a little more clarification. Could somebody who asked that question give us more detail?
Yes, it's me. But I'm afraid I'm one of those people who hands all of my stuff over to my accountant and just let them work their magic on my tax return. So what he currently gets me to do is I collect my rent off my rentals, but I take a percentage of each rent from each property and I funnel it through a corporation that pays less tax. What I'm hearing now is that that won't be possible in the future under the current tax laws.
Well, I think what you're talking about is commissions for the management fees. Is that what you're referring to?
Management fees.
Management fees,
I'm paying my own company to manage the properties.
So I can't imagine that the percentage would be an issue.
So, like, we need more facts on that, but most likely you're doing a UNS corporation?
No, C.
You're paying a C corporation? And then you're taking salary from there, or you're leaving the money in there?
No, I don't take salary.
You just let it build up? Well, that's why you're...
It's minimal.
Pardon me?
It's minimal.
Oh.
It's minimal.
Okay. Well, I'm not sure of that limitation, but you should be able to... I mean, I have multiple apartment complexes, and they all charge percentage of rent for management fees.
I was just, my accountants told me that you can't do it just as a percentage anymore. It would have to be some kind of fixed fee instead of a percentage.
Yeah, I'm not aware of anything.
So is that something that we need to follow up on?
Yeah, I mean, I wouldn't have a problem doing a percentage of rents. I don't hear anything different.
Okay, next question.
Be lowering her 20% deduction, though, that deduction for the pass-throughs?
Yeah, well, the ball game has
She's
changed.
lowering that, so...
The ball game has changed. Everything has changed. So, you know, you really got to reevaluate your procedures as to what you're doing, okay? And take the new tax law into effect. And that's something you're going to have to get with your accountant so he can build up his billable allowance.
All right, a C corporation, I believe, is not a pass-through, so the 20% pass-through deduction would not apply. So give some thought to whether a C corporation is continuing to be your best choice of entity.
Does that answer your question? No? Okay. All right, we'll continue here. Dennis, I thought you had your hand up. What business entity offers the best tax advantage for holding real estate, S, LLC, or sole proprietorship?
I think we mentioned that.
We covered that before, okay. Whatever that means, what's the best IT bookkeeping and tracking app and or software to be ready for tax time? What do you guys recommend besides a shoebox?
All right, my first choice is QuickBooks Desktop, QuickBooks Pro. I don't recommend QuickBooks Online. I've had some bad experiences with it, especially with clients who are not familiar with double entry accounting. And if some of you are in here, I apologize. But you can make a mess of things in QuickBooks Online, and it's next to impossible to fix it, other than starting over from scratch, and nobody wants to do that. I've used Wave. That's an online accounting service. Anybody use Wave? All right, it's low end. It's not the cure-all, but is it free? So it can't be free. And we do have some experience with that.
Anything else? Any other suggestions?
Anyone? I guess not.
Okay, all right. Yeah, sure. Get to the mic, please.
How about tracking your receipts?
Could you speak straight into the mic?
An app that actually tracks your receipts. You know, either be...
There are a number of online apps that you can use to track expense receipts.
I have used like Evernote to take pictures of your receipts just to keep track of them so that you can present them to your accountant at the end of the year?
In my experience, excuse me, in my experience, the best type of bookkeeping system that you should have is something that is very basic, but it's double entry, okay? A single entry system doesn't work, okay? Because it doesn't track how much, there's two basic things. You got to account for how much came in to the bank account and how much went out, all right? Now, a lot of things that come in are not rent. They could be investment in the company. It could be a return of taxes. It could be anything. So you've got to be able to track those two things. How much comes in total, and basically it has to equal all the total deposits for the year, and how much went out and how they went out. And again, the total should be all the disbursements that went out through. It's that simple. Whatever program that does that best for you and easiest for you is fine, but at least that's the end result.
I think what I was getting at is more like a way, if I'm traveling and I have meals, I have my flight tickets, and I want to take pictures of my receipts to keep track of them, what is the best way instead of taking those receipts and put them in a shoebox and then giving it to the accountant and say, here, you figure it out. I want to have a digital copy of all my receipts to give to you at the end of the year.
All right,
Is there something out there that I can use?
I think I understand where you're getting at. All right, so let's just, as business owners, you should all have a segregated set of business records separate from your personal records. That's a given. Let's hope that everybody knows to do that. So that means you're going to open up your own bank account for your business, and you're going to get a credit card for your business. Now, once you get that credit card, if you're interested in getting creative, your credit card company will allow you to do some programming, basically, that will allow you to allocate to certain expense categories each expenditure that you have. Now, that doesn't change the need for physical receipts or pictures of your receipts, but you can do a hell of a lot of work just using a segregated bank account and credit card account and using those to the maximum benefit possible. If you do that, your accountant's going to be delighted with you, because then all you've got to do is hand them access to your credit card online, your bank account online. We can download those transactions directly into our accounting software, and with some modest manipulation, come up with a set of financial statements in short order. That's the ideal from our point of view. Anybody else want to comment on that?
Yeah. Another thing.
I have a comment. Are you a DIG member? If you're a DIG member, you can go on the answer line. And just recently, this question came up on the answer line. There were several software packages recommended.
Well, what I'm really looking for is I'm not looking for QuickBooks. I'm not looking for when I travel, like tonight, I got a receipt. I want to take a digital snapshot of that receipt. I no longer want to hang on to that paper. I just want to throw it away. It's just taking up file space.
How did you pay for it?
Credit card. But is that acceptable? Or is the government going to come back and say, I'm going to audit you, where's that receipt?
If you're keeping records on a digital file, that's fine.
Grab the mic, please. Use the mic.
If you're using record keeping on a digital file of your receipt, fine. Nothing wrong with that. You don't have to have the original. Okay. But there's two different things of keeping receipts, and original documents, and doing the accounting or the bookkeeping. Now, when I say that, let me differentiate between the two, okay? There are, when someone does your books and your record keeping, that's a bookkeeper, okay? If someone is doing your accounting and doing either financial statements or tax returns, that's an accountant, okay? They can be the same person. They don't have to be two different people, but because some accountants do bookkeeping, okay? Some accountants don't do bookkeeping, okay? And you can have, as we had a client before, you can have a client has a bookkeeper, okay? Either can be an employee or a contractor of that business, okay? Then that bookkeeper gives those records to the accountant. And then the accountant prepares the tax return or the financial statement. Again, they can be two different people, they can be the same people, okay?
Thank you very much.
Thank you. It's on. Speak straight into it, please.
I just wanted to mention that if you are working in QuickBooks and you are using a credit card for all of your expenses, you can download that information from the credit card right into QuickBooks and keep track of all the expenses that way. And you can attribute each expense to any category you want to.
And you can also leave that up to your accountant, because classifying those expenditures can be a critical step in that process.
Okay. Any other questions on that subject? Did you want to say something? Oh, okay. Okay, so next question. Somebody attended the DIG 101 tax course, and a handout stated the home equity lines of credit interest may now not be deductible. Another handout said that under $100,000 HELOC interest was deductible. Need clarification on which it may be. Is that person in the room?
It's not deductible if it was used for personal purposes.
The interest expense.
The interest expense, right?
Okay.
The debt's right. The interest expense on that debt is not deductible if it's used for personal purposes. Only way it's deductible if it was used to improve or build or modify your home.
Okay. Does that I don't know if that person's in the room, but does that answer your question? Okay, next item. Can you discuss which is the best way to set up your business entity with a partner to buy investment properties with the new tax laws?
I'll give my 2 cents and you guys can chime in. I would say an LLC, it's easy to form. It allows for partners to have different economic benefits, which is not allowed in an S corporation. It allows for more basis to pass through, because generally with real estate you have debt, and that debt on the mortgage is basis for an LLC, which is treated as a partnership as a default for tax purposes. So what's nice about a partnership is I could have partner A, partner B, partner A puts the money in, partner B does all the work. You know, partner A gets a kicker at the end of 20%. You can do all kinds of stuff in a partnership. You cannot do any of that in an S corporation. So I'd say that's the most flexible entity.
Okay, next question. Is there any way to get around the $10,000 tax deduction limit on my personal residence under the new law?
If you've got a business working out of your home, you can have a home office deduction, which will allow you to deduct part of your home mortgage interest and real estate taxes. Let's see, what else?
You mean the next question, or?
No, actually, I'm trying to think of some other way to do it. It's really about whether or not you're using it for business purposes or not.
I have to remember, because I told you I've been around quite a bit doing taxes, and my experience has been the law is going to come out, everybody's going to talk about it, and toward the end of the year, you're going to find some very, very high-cost attorneys figuring out the ways around it. So right now, it's a little bit too early. You'll hear about it in the rest of the year when attorneys start to chime in.
So
nothing against attorneys, don't get me wrong.
We'll have you back towards the end of the year after tax season.
And you're going to have a couple of high-priced attorneys.
And you can clarify that. Yeah. Okay, I thought the HELOC was going to be deductible, I think, for investment property use. Didn't we cover that already? Yeah, okay. Has AMT been repealed?
No.
No, just changed.
Hold on. I'm going to let Tom take that one, because the AMT has not been repealed, but the limits have been so much changed that AMT is going to be a rare thing for somebody to pay. Certainly not anywhere near the extent that it has in the past. Tom, you want to add anything to that?
Okay, apparently HELOC is a big issue here. Can you deduct HELOC interest if you need the money to buy and rehab an investment property?
On that investment property.
Well, yes.
On that investment property,
Right.
against that investment company, and against that investment property income. Has nothing to do with personal return.
Right, okay. So Chris, if you're in the room, asks, there's Chris, would love to hear about the 20% off the top option, where you could deduct 20% of your income as a business expense. Hope I've phrased this correctly.
I don't think it's so much as a business expense as it is an exclusion of your income. I mean, whatever you call it, it's still the same thing, whether you call it an expense. But I think the way the law references is as an exclusion of your income. And then there's some really definitive rules as to who can do it and who can't.
Chris, does that answer your question?
As a related comment, first of all, someone asked me the question a little earlier, the 20% flow-through deduction. Well, first of all, the flow-through deduction is basically for lower income under $350,000 is basically a 20% deduction on your business income. It doesn't reduce your income on page 1 of your Form 1040. It's a deduction that appears below the line, in other words, on page 2 of your Form 1040. And as such, it does not reduce your self-employment tax. Sorry about that. And this is, let's see, what was the question on the screen? 20% off the top. So it's not a business expense. It doesn't affect your adjusted gross income. It's actually going to show as a deduction on page 2 of your Form 1040.
Does that answer your question, Chris? Okay. HELOC on personal residence no longer deductible, but what about a HELOC on a rental property? I think we've covered that.
Yes, it's deductible.
Yeah. 10 years ago, I used a HELOC on my personal property to acquire an investment property. What record keeping is needed to maintain the deductibility?
No change, I think.
You have to be able to show.
Use the mic, please.
Sorry. You have to be able to show, you got to track that investment, that mortgage. You have to be able to track it, okay? Now, if you added on additional borrowings onto that HELOC for something else, you've got to separate that. So you've got to be able to track it and say, this is how much is part of my investment, and then you're going to deduct that interest on only the part that had to do with your investment in the property is going to be an expense of the property. The other part, which was personal, had nothing to do with the property, you can't deduct.
Okay, next question. Can I deduct a balance transfer? This is pretty creative. Can I deduct a balance transfer fee from my credit cards if I use the funds for an investment property? What documentation might I need to prove this?
You're going to have it on the, it's going to be charged on the credit card.
On the statement, but it may not be clear as to what is being used for. That's
I mean, if you're borrowing completely for the investment property, then it's a deduction as either credit card costs or interest card on the investment property.
Okay.
This is another really good reason to have segregated records from your personal and business transactions. If you've got an accountant going through one credit card that has both personal and business transactions, number one, you're wasting his time, you're wasting your money, and the chances that the IRS is going to look at that, where'd the question go? The transfer fees, and go, well, it's not on exclusively business use, so we're going to disallow it.
Okay.
I have 4 different credit cards in my pocket. Each one is for a different purpose. One of them is for things that I just purchased for my office, and that's all I do is purchase supplies, postage, Whatever that needs to be for my office, I put on that card, so I know that the total on that card is what I'm going to charge. But anything else, I put on another card. If it's personal, I'll put it on another card. Okay?
So on the credit card, and to the gentleman's point about receipts, my experience is that IRS auditors are not sophisticated. I'm not saying they're not smart. I'm just saying they want to just do their job and they want to look at the easy stuff. So one of the easy things they look at is for an operating business. They say, let me see all your bank statements. And they look at all your deposits. And their assumption is every deposit is a receipt. It should be income on the return. So that's number one. Make sure that all ties out. Then they look at your expenses on the credit cards. I've had this happen. And a lot of the credit card receipts are self-explanatory. I stayed at the Sheraton. Okay, I stayed at the Sheraton. I ate dinner at East Cuisine. Okay, that's a restaurant. But when you have things like Amazon, Costco, they will ask for the receipt. I mean, because there could be 10 things in that Amazon charge. So stuff like that, that's not really self-descriptive. I would try to keep the documentation. But my experience is they're not audited. So things like meals and entertainment, credit cards, they're going to look at all that stuff because that's kind of the easy stuff. When you get the sophisticated stuff like interest tracking, their head will explode. I mean, seriously, as long as you have documentation, I found that I have to educate the IRS auditors half the time about what they're looking for. And with rental real estate, one of the red flags is if you have a loss on your K-1, they think, oh, you're not allowed to take the loss because you have no basis, but you do have basis. So those are things they look at.
Okay, next question. Were there any changes to the rule that if a business showed a loss for multiple years, 3 years in a row, that it is then considered a hobby?
No. Simple answer. No. Everything's the same.
Okay. What will satisfy interest tracing? It's either tracing or tracking rules.
Well, just as it says, tracking, you've got to be able to track the interest expense applicable to what you're borrowing the money for. It's very simple. It's basic as that.
Okay, well, the last question we have on SliDo, unless anybody adds to it, is if an LLC only earns interest, does self-employment tax apply?
LLC earns interest? It's interest. It's not earnings. I mean, interest is interest. It's not earnings of the LLC. Yes, it adds into the income, but it's not earnings of the LLC.
It's not subject to SC.
It's not subject to SC.
Take the mic, please.
Questions?
Okay, so that's the last SliDo question. Any other questions from the room?
Go ahead.
Somebody had, is that, wait, Ken, grab the mic, please. Don't break it, just grab it.
If somebody had a business that they terribly commingled funds out of sloppy habit in 2017, hypothetically speaking, how do you go about reconciling that in the next following years? I mean, you basically just hope you don't get audited.
No, you've got to, since you know about it, you've got to do something about it. You got to institute controls and institute programs so it doesn't happen again.
Starting on board, but what about tomorrow?
Well, if you start today, that'll be one thing. If you're going to do it for back years, somebody's got to sit down and do the work, basically.
It sounds like a weekend project, Kenny. Yeah. Yes, grab a mic, please. Tom?
Can you give a little bit more detail about the deductibility of interest for vehicles in the new tax plan? Strictly business? Is it certain vehicle weight? All the details on that.
Well, when you're talking about the interest portion, okay, the interest deductibility goes along hand in hand with the amount of business use of the vehicle, okay? That's one of they match up. If you're using the vehicle for half for the business and half personal, then your interest is going to be half deductible and half personal, okay? It has nothing to do with the depreciation. That's another issue altogether.
So in the past, I've recommended to my clients with less expensive vehicles anyway, just use a mileage method. But given the fact that the depreciation numbers have skyrocketed this year for 2018, I'm not sure I would recommend that anymore. You might want to look at the actual costs that you're incurring for the running of your vehicle. And so make sure you keep good records there and report them all to your accountant. He'll do an analysis based on the percentage of use, the number of miles you use over the course of the year, the cost of the vehicle, and all your other operating expenses, and determine whether the mileage method or the actual cost method would be better.
By the way, there's an app, I think it's called Mile IQ. Mile IQ. Anybody use that?
I know a few people that
yeah, so Tom, that might be useful for you.
It's pretty good if you're using your car for business every day, and you do put on various amounts, or you're going out to clients or meeting people, it's pretty good.
So basically, the way it works is it connects to the GPS satellite, and it knows when you started and when you stopped. It calculates the mileage. Here's
the basis. If you're going to get audited for the business use of your vehicle or any property, okay, especially you've got to have something that looks reasonable to the amount of income. If you're only making, I'm just making a number, $25,000 a year, and you've got automobile expense for $75,000, obviously that's not reasonable, okay? But if you try to keep some kind of records, okay, they don't want it to be perfect, but if you have some type of records, it makes some sense, you'll be able to sustain any kind of an audit.
Okay. Any other questions? Comments and/or? Oh, another question. There we go. If you advertise on vehicle, so thanks. Was this from you, Bonnie? Okay, so if you get one of those stickies on the side of your car that says buying houses or selling houses or whatever it says, can you use as full business deductible? Do you mean the signage or the car?
The cost,
the car.
The cost of doing that is fully deductible. The car, I mean.
So now your car is advertising.
It depends upon, wait a minute, it depends upon what kind of a car. Is it a small truck or a small hybrid or something? That's fine. Is it on a Cadillac or Lexus or Maserati? I think you're going to have a problem.
Why?
Well, the only thing segregated treatment I've seen is for vehicles with gross vehicle weight over 6,500 pounds, I believe. It's my understanding that the fact that you've got advertising on the side of the car doesn't change anything.
Bonnie, does that answer your question? Yeah. Okay. Any other questions? Okay. Well, I didn't have it. Okay. So before we give our, let's give our panel a great round of applause. Thanks, guys. You put up with a lot of nonsense a lot of questions from all of us, so thank you very much. But